the only way to move that metal is they're going to have to come up with incentives, really aggressive incentives. There's only so much time that they can kick that can down the road. Going into 2025, I think it's going to be a fire sale for new cars, which means that the OE is going to really step up on offering some really great leasing opportunities and finance opportunities. So the precision that we have at origination, whether it's a new car or a used car, is critical for our financial partners. We're going to see a hemorrhaging of really good consumers who got into a trick bag. I don't believe in thinking outside of the box. Throw the box away. Even thinking outside of the box is still limiting.
Hey everyone, welcome to Leadership in the Dealership, the podcast where we dive into the latest trends shaping the automotive world with insights from today's thought leaders. I'm your host, Danielle Mills Walden, and I'm super excited for our discussion today with Paul Machin, who is the U.S. and International Director of Strategic Accounts with Black Book. Paul, welcome to the show.
Thank you, Danielle. I'm humbled to be here, and I'm looking forward to our conversation. We always have some great conversations, so this will be fun.
So much fun. We are really thrilled to have you here today. And, for those who may not know you or Black Book as well as we do, would you do us a favor and do a quick intro of kind of how you got started in the auto industry and then give us a brief overview of Black Book?
I'll give a quick summary. I was born in the business, so to speak. Not really, but I've been in it since I was 19, 13, 14, 15 and a half years on the retail side. One of my claims to fame is I opened up the CarMax location here in Greenville, South Carolina, and ran that for 5 years, and was recruited from there and ended up being a partner in a Nissan store locally for a while. And then I was recruited to DealerTrack, my first foray into software as a service. And that was a wonderful experience. Did that for almost 13 and a half years. And now I'm with Black Book. Did a small startup out west for a little bit, but I came back, and my good friend Jared recruited me to come to Black Book, and I've been enjoying this ever since. Now I'm on the data as a service side of the business.
Oh my gosh. Okay. Well, I love how you talked about, being born in this industry. Can you tell us a little bit more about Black Book for those who may not be familiar too?
So Black Book has been around since the early 50s. So we're like a mainstay in the industry. I'm sure if you were to, do a round robin, a bunch of your friends and ask them questions like, hey, when you go to a dealership to trade your car, there's another book, right? I mean, there's a real value that they're just not showing you. And almost everyone will agree with you when you ask that question. And that's the Black Book number. We're not really a consumer-facing number. We are for the community, for the dealerships at large. I always like to say that we're the check writing number that dealers tend to start with when they go bid for vehicles. Auctions use it as a way to offset originations. I mean, they're wholesales and lenders use it to understand risk and to mitigate that risk on their portfolios that they have. So we've been around for quite a bit.
Yeah, definitely a long time in the industry. I can say this because I know that you guys have thousands of data points that are published. How do these metrics empower your customers to enhance their products and services in the industry?
With the way things are so uncertain today, Danielle, we definitely know that the more accurate the information we have, the better decisions we can make, both as a business, right? When it comes to execution, we're executing off of data points that we're supposed to trust and be reliable, and that's where we come in because we're third party, we're independent from the automotive vertical. When I mean that, what I mean by that is that we're not owned by auction houses. So we don't have a need to influence an auction number. We're not owned by investment institutions, any financial institutions or investment groups. So we don't have a need to influence those numbers. And we're definitely not owned by mass marketing companies that produce software as a service solutions that cater to the automotive industry. So we don't have a need to make sure that our number is present. One of the things that I love to talk about is that in a typical dealership, Danielle, you'll find that the average dealership today is partners with 7 to 9 different technology partners that are using Black Book data integrated into their solutions. So it's a really comfortable position to be in because we pride ourselves on delivering that precision data that allows us to have that kind of presence in the organizations.
No, I love that. You said 7 to 9 different technology sources that could be touching Black Book at any given moment. I'm sure that that's really helpful because then you know that it's unbiased. It's coming from one place and it's really, really valid. I'm curious from your perspective, with just how things have just been rapidly changing so much in this landscape. How do you guys really maintain that credibility and accuracy that's so crucial for your customers?
Oh, well, that's a great question. So we like to say we blend art with science, right? So the art side of the business, we have people that still go to the physical auctions. If you've ever been to one and you see someone dressed, usually wearing khaki pants or shorts, depending on the weather, they got a clipboard, and they're just documenting every vehicle that comes through. We do that, just have a presence within the auction so we can talk to the buyers and to the dealers and to the banks that are selling and buying back and forth. So we get firsthand interactive experience from just doing that. So that's that art side. We probably got over 400 years worth of experience and knowledge of my data analysts who do nothing but dissect the macro and microeconomic factors that go into executing decisions on vehicles. Then the second part on the science is the data analytics piece. As we all know, data has now become the new liquid gold, so to speak, in the industry. But the precision of the data is really, really critical. One of the things we did about 7 years ago is we introduced something called history-adjusted valuations. And it kind of shook the industry up quite aggressively, especially in the wholesale side of the market, because for the first time, you're able to determine the true cost of that one VIN number, that specific VIN number, not an aggregate VIN number, but that one specific VIN number, right? So Danielle, imagine looking at a 2017 vehicle that 20,000 miles, and you think it's a great buy. But now when you look at the history adjusted value, you see there might be a negative deduction of almost half the price of the vehicle. Well, that's because that was a salvage title vehicle. You have families and family members and friends and neighbors who will never buy a vehicle without looking at a vehicle history report, right? So what's that worth? What is that vehicle history report worth? So we figured out a way through data science and analytics with some of the largest dealer, with one of the largest dealer groups in the nation. We partnered with them to understand how to come up with an AI that can give us a dollar value associated to that vehicle's history. So that's just one of the ways that we've done that we've introduced change in the market. And when it first came out, Danielle, I can tell you, we had some people on the wholesale side that didn't like us, because we were exposing them. I mean, think about that. They're passing off a clean title vehicle, and guess what? It's not a clean title vehicle, and we have the records to document and support that.
Wow, no, that's really powerful because you're really arming the dealer with this information so that they can make a better decision with that vehicle and be able to support their customers. I'm curious because you were talking about the wholesale market. Over the past few months, we've seen a lot of changes in the wholesale vehicle market. And I'm interested, like how Black Book has been adjusting to that increased volatility in the used car prices, and what data insights are you using to help keep dealers ahead of these trends?
So one of the things that we publish a publication called Black Book Insights, and actually yesterday they came out and they basically said that the vehicle segment as a whole, cars, not trucks. First time that we've seen a depreciation in line across all 9 segments, right? So usually you see, 4 or 5 segments might drop and then the other 4 or 5 might go up. It just depends. So the challenge is monitoring not by a category of vehicles, but by segments of vehicles. So we do that for both cars and we do that for both trucks. And because we're monitoring, so we auctions every day, we're getting all this feedback from the auctions. We have partnership with every major DMS provider in the nation. So we're getting anonymous data sets from that. We get anonymized data from other partners who buy and sell vehicles within the marketplace. And we update that data set every day. I'll give you a great example. In June, this past June, and one of the vlogs I put out, I think it was the second week of June, I reported that dealers need to embrace that they need to start leaning out their inventory through June and July to get ready for the transition that we're going to experience in August. And sure enough, we saw a significant decline from June, from the moment I made that warning through the end of August. And now we're seeing the values have kind of stabilized. And we think that's going to be pretty good through the rest of the year. And then we are expecting about an 8% shortfall on used vehicle available inventory. And that specifically that 0 to 4 year old prime inventory that's affordable, that dealers are so desperately searching for today. And so overall, we're talking about an 8% reduction in available vehicles to buy in 2025. So there are strategies and plans that, as you know, I implement that I suggest on every single vlog that dealers need to start embracing today to offset the fact they can't find that inventory out in the wholesale market.
Wow, just the fact that it's decreasing so much, they're going to have to be very strategic in order to take advantage of that. I'm curious your perspective when it comes to like supply chain, the disruptions in the supply chain and inventory levels. How you've been advising your clients around those so that they can optimize their used vehicle prices and avoid being caught by pricing pressures.
Oh, that's a great, another fantastic question there. So, let's talk a little bit about electric vehicles. Everyone's all hot and excited about EVs, right? But there are some supply chain challenges with the EV market, especially as it relates to the core ingredients needed to create just the electric vehicle batteries. And then you talk about the logistics around transporting those ingredients, because they're mostly farmed internationally, produced internationally, and then they got to be shipped here. Well, then we're impacted by any kind of shipping disruption, from the bridge that happened in New Jersey to the pending strike that we narrowly avoided on all the ports. You know, even though that didn't happen, it still put a pinch on about 2 weeks of, oh my God, people were freaking out. So they were hoarding and, trying to get as much as they can. And at the same time, it made it lean for the next 2 weeks until the next shipments are coming through. So we advise that again, it's segment based. It's not wholesale across the entire, not like it was in the middle of the pandemic when we had that supply chain crisis. It affected every vehicle, right? Now we're seeing pockets of vehicles that are getting affected, like, and I won't say the brand or the manufacturer, but something as simple as a particular type of a bolt that goes into the seat, or something that a transistor that needs to go into a transmission. And so these vehicles have to be held back. Or how about decontenting a vehicle? You used to be able to buy a vehicle, if it was said limited, it means it had everything on it, right? Now you get into it limited today, and you're like, oh, where's the heated seats? And you start looking around, it may not have the component for these heated seats, but you have an IOU. So when that part becomes available, you can get the heated seats. My wife and I bought a Jeep Grand Cherokee in 2023. Great dealer, former partner of mine. That guy was phenomenal. Business was phenomenal. It took us 6 months before we were able to get the running boards, the factory running boards, because of the supply chain. So it's really good. It's when we understand what's slowing down the market, we can also understand what particular segments are going to increase in value, because that segment becomes limited in availability.
No, that's really powerful. Just thinking you waiting that long just for something like a running board That's
I know.
something so simple, but what are dealers, how are they handling that? The fact that they're going to have to explain that to customers. Do you see that when it comes to this, are customers being understanding of this, or a lot of times are they not getting it because they've always had this when buying cars?
Oh, so this is experiential. I talk to my dealers often, quite a bit throughout the day. And some of the feedback that I've been hearing is that most customers understand it and they recognize that that's the one I want. Yeah, it might be missing the heated steering wheel, but I want that one. And so they're making that allowance to do that. That decontented vehicle that's in the market right now. Then you get the exact same vehicle that now is fully contented. One's used, one's brand new. When that brand new one becomes used, just by virtue of having more content, it has a different value. So you can't appraise the equity position in those two vehicles. Let's say return on asset, right? The return on asset is not the same. It could be the exact year, make, model, trim, but there's a feature or option that makes a difference, a significant difference. So an example like a tow hitch on a truck. If we have some trucks in the market that don't have tow hitches because of the supply chain crisis. Well, guess what? When that truck goes back into the market wholesale, there's a hard hit of several $100s for not having a tow hitch. So understanding how to properly classify a contented vehicle, that's VIN-specific information, and that's what we provide.
Wow, it's hard to believe that a truck wouldn't have a tow hitch, but the fact that they
I
even
know,
make some
right?
without them is just crazy.
Yeah. So that's the funny part. It's great you brought that up, right? There's not the value of the truck is including a tow hitch. It's not a separate, it has a tow hitch, and let's add another $300-400. It's supposed to have a tow hitch. And to your point, it doesn't have a tow hitch. Oh, brother, I got to deduct. It's less desirable.
Absolutely. Oh my gosh. Well, to switch gears a little bit, I know in the past you've mentioned the K-shaped recovery and how it's impacting both new and used vehicle markets. Can you explain what that means for dealers and shoppers, especially with the recent shifts in credit availability and inventory shortages?
Oh, first of all, how much time do we have? Wow. I've been talking about this since the very beginning of the pandemic. I'd say it's my second or third vlog in 2020 that I did. I mentioned, here's what I predict is going to happen. And I talked about the K-shaped recovery. And the reason why the economists call it a K-shape is because you have two portions, right? You have an upper leg of the K and a lower leg of the K. And there are two different types of now what I call is a selective recession. There are two categories of people in those legs. The K-shaped recovery, or the selective recession, has had a significant impact on the people in the lower leg. So the people in the upper leg, they're still struggling, right? Some are, I think I read an article recently put out by Bloomberg that said it takes $124,000 a year on average across the nation just to make it family of two. That's pretty intense. Then there's another article that came out that if you're a family of four, and you got different ages, and they're talking about all the cost for colleges and savings and food, they're saying over $200,000 a year may not be enough. But if you're in the upper leg of that K, that selective recession, you feel the pinch of the cost of living today, but not to the degree if you're on the lower leg. So let's back up a little bit. What happens to the majority of the people that there was a branch of people, segments, let's say segments, that pre-pandemic were considered prime credit, all right? And through no fault of their own, these are people who were raised on credit. They were raised to manage their credit. They were raised to pay their bills. They were basically raised, you don't live off of your check. You live off of your credit cards, and you pay your credit cards off at the end of the month, right? That segment of the population, 650 credit score, was considered prime credit pre-pandemic. Today, a 650 credit score is now considered near prime. Think about that for a second. You just drastically altered the industry, the financial industry, drastically altered the financial experiences that consumers who are used to being 650 and above, 650 to 700, getting preferred treatment, preferred rates, getting the best of everything. And all of a sudden, just like that, they're in the lower leg of this selective recession. Their interest rates are more expensive. They can't qualify for the same rates and terms they used to be able to get. Since we're talking about automobiles, let's talk about loan to value advance. A significant portion of that approval process is dependent on the consumer's credit score. It used to be ability, stability, and willingness to pay. Now it's credit score, stability, ability, and willingness to pay. So there's a class of consumers that are still, in my opinion, that have been lowered from the upper leg down to the lower leg. They are financially responsible consumers. They pay their bills still. Yes, they're stressed. They're paying higher rates than they've ever had to pay before, and they don't like it, but they understand they just got to get through it, right? But you know what they're not? They're not a subprime consumer. They're not even a near prime consumer. So as financial institutions and dealers, I encourage, don't bucket these class categories of people as a standard near prime or as a subprime consumer, because they won't tolerate that treatment. They're used to preferred treatment, and that's what they want. Regardless of the fact that their credit score might be low, everything else is good. These are consumers who might have a high debt leverage ratio, but they pay their bills. And because of that, they're getting dinged.
There's a lot you said there that I wanted to unpack a little bit, but I'm curious for your perspective. Like, are you seeing that big change for these consumers from leasing too? Because I'm sure in the past, these are people that would be able to lease and there was good lease programs. And then now with that credit falling into that range, they're not going to be attractive for them.
Not in the most parts, but so here's the catch-22 with that, right? The OEs are the ones who come out with the best leasing programs. There are a handful of financial institutions that will do a lease, but it's really hard to compete against a subvened interest rate, money rate factor, or a residual valuation that the OE is willing to take the risk on, right? So we have a unique dynamic now. We have more new car inventory sitting on the grounds at dealerships nationwide, even right about pre-pandemic levels. And some of our OEs have inventory on certain models for 3 years sitting on the ground. If you think about that. So the only way to move that metal is they're going to have to come up with incentives, really aggressive incentives. There's only so much time that they can kick that can down the road. And, we predict that the incentive rates will be close to 8 to 10% on average by the end of the year. But going into 2025, I think it's going to be a fire sale for new cars, right? Which means that the OE is going to really step up on offering some really great leasing opportunities and finance opportunities. And because the OE also owns the lender itself, they can also do some things that are not typical by standard financial institutions. But so a Chase Manhattan Bank cannot do what, let's say, GM might do or Toyota might do, right? Or even if Upstart might be able to do. They just won't do it. And I see that change will benefit that segment of people who went into the lower leg huge next year. It might be mid-year before all the programs coalesce and the competition between one bank to one bank says, okay, I need to adjust my scorecard because I'm losing business to XYZ lender or vice versa. So I think you'll see that significant change. Now, part of that too, Danielle, is assuming the risk of the inventory. All right. So the lender, whoever it is, has a financial responsibility to make sure that loan or lease is paid properly. Well, who do they ultimately want to make sure that if they've got to take that vehicle back and they got to go to the auction with it as required by law, what's it worth? That's a Black Book number. So the precision that we have at origination, whether it's a new car or a used car, is critical for our financial partners, because a dealer, no matter who they are, cannot operate while having a handful of really strong financial partners. They're dependent on what they can do when it comes time to liquidate that lease or that loan. And the more favorable position we can help them be in by making sure we put right valuations, the better it is for all of us all the way around.
Yeah, I mean, trying to make sure that these dealers are prepared for what's coming. I do have one other question before we kind of switch gears in regards to this. You remember during the pandemic when so many dealers were inflating the numbers and there was all these addendums and they were marking up everything. From your perspective, like how is that kind of like turned around now, and what are dealers, what can they expect with that now that those customers hemorrhaging?
We're going to see a hemorrhaging of really good consumers who got into a trick bag. You figure the saving grace is that we had almost 4 years of low new vehicle sales and leases. So we don't have as many out there in the market as we normally would. Like we don't have 16 to 17 million sales years for the last 4 years. So that's a good part. But to your point, we have some significant overvalued inventory that's in the market right now. Without saying any lender financial institutions' names, we have a lot of our well-known banks are in trouble with a certain segment of inventory that they have over-financed. And these are consumers can't trade out. Edmunds just put out an article, and I'm not sure if you saw it, I think it was 2 weeks ago, said that 1 in 5 trade-ins had $10,000 or more negative equity. Right? But think about the title. I mean, that was their title, right? So that means that's all they could track. They could only track the negative equity on the ones that were traded. But what about the ones that were not traded? Because the negative equity was greater than that. I have a neighbor who bought an electric truck right at the height of it. He just had to have it. The guy owes about $134,000 more than what that vehicle is worth today. And he's not alone. He's not alone. I talked to a lot of my buddies still in the dealer world. Their biggest struggle is finding someone who has, it used to be, I want to get someone who has a vehicle that it's either worth what they owe or has equity. Now the hope is, how close to near equity can I get? Can I get to $3,000 negative equity? Because I might be able to get someone out of that vehicle. Now it's, can I get to $5,000 of negative equity combined with factory incentives and discounts? And maybe I can squeeze 12, 1,500, maybe $2,000 out of the customer. I can trade them out. But $10,000 negative equity, impossible.
Yeah, that's
not unless they're a Highline vehicle, a customer trying to buy a Highline vehicle. So we're going to see some repossessions that's going to be staggering in 2025 too.
Yeah, that's a good point, because these dealers are going to have to get really creative and to keep these customers basically not to the fault of the customer necessarily, that the situation that they're in because of the, market, but the leadership of that dealership is going to be important of how they can kind of guide that customer through that experience and be there to support them. And that's kind of a perfect segue into what I want to get into, because, every episode we spotlight a dealer that we want you to actually put a spotlight on a dealer that you feel, has really been successful in their processes, the technology that they have, the way that they embrace change. And I'm curious, from your perspective, you worked with hundreds of dealers, or even thousands at this point, over the course of your long career across the industry. Who is somebody that you'd want to kind of call out or shout out for what they're doing and that you see a lot of value in what they're doing?
We can always talk about the large dealer groups, right? They tend to have the resources, both human and financial capital to use to make sure they're always doing the best they can. But in the mid-sized group category, I really love what Brett Sutherland of the Sutherland Auto Group, what he's doing. As a partner, he's created one of my key core philosophies is a one service RO, one appraisal, one cash offer, right? That's my number one out of my 7 that I put out there every time. My number one is service drive RO, service check writing offer. You never know. It could be just an oil change, and they've had 3 offers before. And now this 4th one, you know what? I might want to do something. what's the worst that can happen to a dealer who creates that process to do 100% service appraisal? They might buy 30, 40% of that service inventory that comes through and maybe only keep 20%. Well, that 20% is the best inventory they can get anywhere. And then they have a wholesale opportunity on the remaining, or creating a new market to sell to, because there's a limited supply of affordable pre-owned vehicles in the market today. It's the lowest that we've ever had. So the Sutherland Auto Group is doing that job fantastic. He's at the point now where he's acquiring about 70% of his service of the service appraisals across the organization, where he doesn't. His dependency at the lane is become less and less and less. I'm not trying to take anything away from the auctions. We need to supplement what we can get from the auctions, and that's what he's done.
No, that's powerful. You called him out for that specific reason, because not only is he able to pull from his own service drives, but he's keeping that customer. That's a customer that they can retain and be able to sell to and keep that relationship. So kudos to him and what they're doing at Sutherland. I'm glad that you called them out for that specific reason.
Oh, yeah. It's 6 stores now, and he's looking to buy more. It's phenomenal what he's done in just a short period of time, because I have an expression that I picked up from a good friend of mine, Greg Becker. I don't believe in thinking outside of the box. Throw the box away. Even thinking outside of the box is still limiting, right? Just throw the box away. Whatever, why not, right? That question, why not? Why can't I do this? What's going to keep me from doing this? How can I improve implementing a program like this? One of the things that I want to highlight here is a large dealer group. We talked about the limited availability of pre-owned inventory, right? It used to be that 0 to 3-year-old was the hot spot, but now most of the 0 to 3-year-old inventory in the marketplace is unaffordable when it comes back. So now you got to go older, 4 to 6 years. 4 to 6 years because there's limited supply. Now the demand is starting to pick up. And as you know from Upstart, you're now looking at consumers going older to buy inventory, as old as a 2012 and even older there. We at Black Book, at the request of financial institutions like Upstart and a few others, we figured out a way. We started looking at the data and analyze what a vehicle would be worth, a 2015 model, if it was going to be financed for 3 years. It just blows me away trying to finance a 2015 for 3, 4, or 5 years. How about a 2012 being financed for 3 or 4 or 5 years? That's significant when you think about that, because that risk to the lender. Well, it's happening. So I have this large dealer group that took a look at their inventory profile across every store they own. And they started asking, what percent of inventory do they have in stock, right? That's 2012 to 2015. It hits a sweet spot in pricing. And they found out not enough. What does their competition have? Well, they don't have enough either. So they started intentionally targeting their local communities. It didn't matter if you've never bought a car from them. If the DMV showed that you had that particular year, make, and model inventory in your driveway, you were getting a free safety and oil change. Safety inspection and oil change. Because when that car came through the driveway, guess what else you got? A check writing offer. This one particular large dealer group, 32% of their inventory today is in that affordable category from that 2012 through 2015 model. And no coincidence, they're selling a significant portion of them because they've got it. And they've developed that kind of community relationship now that people know, I need to go there to get a check writing number on my car.
Yeah, well, that's a perfect example of throwing the box away and doing something different than what others are doing. And I'm glad that you shared that with all of us, because that's something that anybody listening to this can look at their own dealership, their inventory, and think, what could I be doing differently to get the results that I need in this market that is so interesting right now?
It's a challenge, right? It's so, all a dealer really has to do is look at their financial relationships. 75% of every sale they make has to be financed or leased, right? So they're dependent on those conditions. So why not figure out what their local community matches those conditions and then find the inventory to match those conditions? It's not like it used to be. I just got to get stock, and then whatever I can sell, sell what I can sell. Now it's sell specifically.
No, absolutely. In closing, I do want to find out from you, what would be your bold prediction for how we kind of wrap up 2024 and then looking into 2025? What insights do you see us going into?
Wow. So the economic uncertainty is the big challenge for us, right? We're due for another possible interest rate drop coming up. But is it likely? Most likely not. The data that the Fed keeps putting out says maybe not. So that's going to put a pinch, but that doesn't prevent the factories from putting year-end incentives out to help them get rid of some of the glut that they have. And I personally know at least a dozen of my friends and neighbors who are not buying a vehicle until the end of the year. So because that's where the biggest rates, the cuts, and the best incentives become available by the factory. Now, how does that impact pre-owned inventory? It's a trickle-down effect, right? If I can get, I'm just throwing a what if out there. I can get $15,000 off of a truck. I won't say the name of the brand, brand new. Then why would I want to spend close to what an MSRP is for a pre-owned truck that I can't get $15,000 off? I can't qualify for special rates and incentives on. So in order for us to sell, for a dealer to sell a like new used compared to a brand new MSRP, they're going to have to discount to get that. So the strategies I've been talking about is you need to buy now. You need to start buying inventory today at December's numbers, not at October's and November's numbers. So that way you're ready to meet the demand for the pricing adjustments. I think the idea, election year is always very challenged, right? So that's going to change a lot of what's going to happen. There are some federal programs that I think could benefit a significant amount of people once the election passes, and we'll see if the programs go through. Because if these programs go through, it'll help the lower leg of the economy, that selective recession you and I talked about earlier. It'll help that class of consumer get out of debt a little bit.
Well, wow, you heard it first, guys, from Paul, what to expect in the upcoming year and the end of this year. Paul, thank you so much for sharing your insights and your expertise with all of us. We learned so much from you today. Where can everybody find you and connect with you?
Well, my email, paul.machin@blackbook.com. You can go to my LinkedIn profile. As you know, active there. That's pretty much the only place I actually do any social media interactions on. And then my cell phone's been around for almost 30 years, so I'm not afraid to share it here. It's 864-238-1234. It's that easy to get a hold of me. It's 1234 right there.
Well, thank you again, Paul. We appreciate you, and thank you for coming on the show.
Oh, Danielle, thank you for the fantastic questions, and I've thoroughly enjoyed this. Thank you.
Awesome. Well, thank you, everyone. Have a good one. Bye-bye.